China has successfully launched the electronic Chinese yuan (ECNY), a state-backed digital currency with an estimated circulation value exceeding 1.2 trillion yuan, according to recent data. This digital currency initiative has established connections with financial institutions across 110 countries, creating an alternative to the traditional SWIFT payment system that has dominated international transactions for decades. Beijing's approach to implementing this financial innovation has been notably strategic, characterized by minimal publicity and a gradual deployment strategy rather than high-profile announcements or legislative fanfare. This methodical approach has allowed the ECNY to gain significant traction without triggering immediate defensive responses from competing financial systems. Recent transaction data indicates approximately $22 million in international settlements have been processed through ECNY channels. The network currently encompasses more than 30 financial institutions spanning 5 countries, with particular adoption in the United Arab Emirates, Thailand, and Hong Kong. A key feature distinguishing these transactions is their complete independence from SWIFT protocols and New York's traditional banking intermediaries. The ECNY system offers substantial operational benefits compared to conventional payment infrastructures, including transaction cost reduction of 50 to 70%, implementation of programmable smart contracts that enable real-time transaction monitoring, automated tax collection, and elimination of intermediary banking services. The technology provides Beijing with unprecedented control over capital flows while offering partner nations reduced friction in cross-border transactions. Pilot programs have demonstrated that letters of credit processed through ECNY are 20 to 30 basis points cheaper than USD-denominated alternatives. The system demonstrates consistent expansion metrics with an annual transaction growth rate of 10 to 15%, increasing participation in the Bridge project by 5 partner countries, and discussion of SWIFT-independent payment systems at the 2024 BRICS Summit. Subscribe to our channel for more in-depth analysis of global financial developments and emerging economic trends that shape our world. US dollar position and global reserve shifts. Evidence suggests the dollar's historical dominance in international finance is facing incremental challenges from multiple directions. International Monetary Fund data from 2024 indicates that global USD reserves have declined to approximately 58% of total holdings, representing their lowest proportion in several decades. Concurrently, the yuan's share in international payment settlements has experienced modest but significant growth, increasing from approximately 2% to 3% between 2023 and 2024 according to SWIFT reporting metrics. The dollar's position is further complicated by domestic economic pressures, with 37% of Americans reporting inability to cover a $400 emergency expense. Average U.S. households experiencing approximately $800 annual cost increases attributed to China tariffs, and 60% of U.S. consumers reporting reduced non-essential expenditures. These economic challenges create a complex environment where the dollar's traditional strengths are being tested both from external competition and internal economic stresses. While the dollar remains the dominant global currency, the incremental shifts in reserve holdings and international settlement preferences suggest a gradual diversification of global financial systems away from absolute dollar dependence. China's semiconductor industry development. Following restrictions on access to Western semiconductor technology, China has implemented a comprehensive strategy to develop indigenous capabilities in this critical sector. Between 2022 and 2024, China directed approximately $75 billion towards semiconductor research and development initiatives. This financial commitment was accompanied by an aggressive talent acquisition strategy that successfully recruited over 50,000 engineers into the national semiconductor workforce, many from leading technology enterprises like Huawei. Despite Western export controls targeting advanced semiconductor manufacturing equipment, Chinese companies have achieved significant technological milestones, including development of 7nm chip manufacturing capability without access to ASML's EUV lithography systems, YMTC's production of 232-layer NAND flash memory technology, and independent development of alternative lithography technologies. China's semiconductor strategy extends beyond individual technological achievements to encompass the creation of a comprehensive and self-sufficient technological ecosystem. By severing ties with major Western suppliers like ASML and TSMC, China has signaled its commitment to technological sovereignty despite short-term disruptions. This strategic independence has transformed China from a market dependent on Western semiconductor technology to an emerging competitor in advanced chip design and fabrication. fundamentally altering the global semiconductor landscape and challenging previously assumed Western technological dominance in this critical sector. Escalating trade tensions. Trade relations between the United States and China have deteriorated significantly, with both nations implementing increasingly severe tariff regimes. The conflict began with U.S. implementation of 25% tariffs on $370 billion of Chinese imports, followed by Chinese countermeasures of equivalent tariffs on $110 billion of American goods. The situation escalated with U.S. tariffs increasing to 125% on selected categories, and the latest Chinese response imposing an 84% tariff rate on American imports. China's retaliatory measures have specifically targeted politically sensitive U.S. sectors including agricultural products, soybeans, pork, automotive manufacturing, export restrictions on rare earth minerals critical to U.S. technology and defense applications, and antitrust investigations of American companies operating in Chinese markets. The European Union initially expressed opposition to the escalating tariff conflict but subsequently modified its position to pursue bilateral negotiations with the United States. This policy reversal demonstrates the complex diplomatic calculations triggered by U.S.-China trade tensions. The impacts of these trade measures extend beyond direct economic effects to influence global supply chains, diplomatic relationships, and strategic positioning between the world's two largest economies. Both sides have framed their actions as defensive responses to the other's aggression, creating a cycle of escalation that has proven difficult to reverse through conventional diplomatic channels. Investment patterns and capital flows. Chinese direct investment in the United States has experienced a dramatic contraction, declining from $46 billion in 2016 to approximately $2.3 billion in 2024. Recent policy directives indicate a complete freeze of remaining Chinese investments in U.S. markets. This investment withdrawal has created significant challenges for U.S. businesses, with companies requiring capital infusions facing borrowing costs as high as 11.3%. Major infrastructure projects being delayed or canceled, and 62% of U.S. manufacturers reporting severe funding shortages for planned expansions. Beyond direct Chinese investment reductions, broader market indicators suggest diminishing confidence in U.S. financial markets, with $120 billion withdrawn from U.S. stock ETFs within a 90-day period. Traditional U.S. investment partners like Norway and Japan reducing their exposure, and U.S. corporations increasingly reliant on high-yield junk bonds with rates averaging 9.6%. The combined effect of tariffs and reduced investment has created measurable economic pressure on U.S. consumers, including average annual household cost increases of approximately $1,950, persistent inflation at 3.6% despite economic slowdown, and stagnant wage growth relative to rising prices. This investment realignment reflects both political tensions and shifting economic calculations about future growth opportunities, with significant implications for long-term capital formation in U.S. markets and the broader global financial system. Strategic implications. The documented developments across digital currency implementation, semiconductor technology, trade policies, and investment patterns indicate a fundamental restructuring of U.S.-China economic relations. Rather than engaging in direct confrontation, China has pursued a multifaceted strategy of developing alternative systems and capabilities that reduce dependence on U.S.-dominated financial and technological infrastructure. This approach suggests a long-term strategic vision focused on creating viable alternatives to existing international economic structures rather than attempting to directly challenge U.S. hegemony in the short term. The gradual nature of these changes has allowed implementation with minimal disruption while steadily advancing Chinese economic interests. For policymakers and business leaders, these developments necessitate a careful reassessment of assumptions regarding global economic integration, technological development pathways, and the future of international financial systems. As both nations continue to pursue their respective economic interests, the resulting competitive dynamics will likely shape global economic structures for decades to come, requiring thoughtful adaptation strategies from businesses and governments worldwide.